and we're going to buy the call immediately above that to cover our position. Okay, so as you can see now our max profit is $470, and we're only risking $30 on this trade. So hey, what's up everybody? So today I'm hoping that the market is going to have a little bit of recovery, but we really don't know. And so a lot of investors are going to be eyeing what's going to be happening in the markets today, and including myself. But today in this video, I actually want to talk about a specific stock option strategy that can make you a lot of money if a stock goes down. Okay, so unfortunately, I wish I had talked about this topic a little more before the correction and before there was a big sell-off, but really no one could have predicted. And this strategy is really when you're more bearish on a stock. Okay, so I wouldn't necessarily do this for a company that has strong earnings, and just something that we could never predict, right? Now, on the other hand, if you do know of a company that is just overvalued, overpriced, people are just buying into the hype, and if you really want to short the stock, this is an option strategy that is much better than shorting, because ultimately shorting can lose you a lot of money. I've had friends who tried to short a company, and unfortunately they lost just a ton of money because they got greedy, right? So this is definitely a bearish strategy. If you're bearish on a company, if you do think it's going to continue to move downwards, then this is a great strategy to try. Okay, so I'm going to be showing you the strategy through Robinhood, and I actually already have set up one of the companies that I'm considering, quote unquote, shorting myself, because I've taken a look at AAON. Okay, so AAON, you can kind of do your own research, is a company that is in the heating, ventilation, and air conditioning company. But right now it's sitting at a P ratio, a price earnings ratio of 49.23. I do think that is pretty high for the amount of money they're making. And so this is a company that I would definitely consider doing this option for. And so just taking a look, I'm going to go into my Robinhood account and show you how to set up this trade. So first you would begin by selling a call option. Okay, so usually you want to keep it close to strike price. So you can either do right now the share price of AON is trading at about $65.66. So if we take a look at the $70 strike, for example, let's say we sell the strike at $70. We're going to go ahead and cover that position by buying a call, okay, right above that. So we sold a call. Sorry, I think it says strike. We sold a call, and we're going to buy a call immediately above that. Okay, so we're just going to keep it real simple. And as you can see now, okay, so if the company continues to move up, we're gonna lose some money. But if it doesn't move up past 8.67%, so let's say the stock moves up by 7 point something percent on February 18th, which is our expiration date, then we're actually gonna make a profit. Okay, so we're risking $365 to make about $135. Okay, so let's kind of change up the trade a little bit. Let's say we move our positions and strike positions a little lower. Okay, so now we're gonna sell the call at a $60 strike price. Okay, so we're gonna go underneath the current strike price, and we're gonna buy the call immediately above that to cover our position. Okay, so as you can see now our max profit is $470, and we're only risking $30 on this trade. So this means that if the stock actually moves beyond negative 1%, if it basically just goes down, then we're going to be making more and more money. And up until a point to, if it goes down by 8%, then we're going to maximize our profit. Hey guys, if this video provides any kind of value to you, I would greatly appreciate if you could hit that like button, just so that I can share this with more people. And make sure to subscribe if you haven't already. Thank you so much, and now back to our video. Okay, so these kind of strategies can make you a lot of money, especially if you are correct in your trade. If you do find a company that's overvalued, if it goes down, just even slightly, or even a couple percentage points, you're going to be making a lot of money. Okay, so let's take a look at another trade. Okay, so this one is a little more popular. A lot of people have been talking about Rivian. Okay, so RI. Okay, so Rivian Automotive. Rivian Automotive, as far as I know, have not turned a profit, but it is a stock that is trading at insane valuations. People think this is going to be the next, Tesla. But as you can see, right, it's over the last couple, just a couple months, it's been down over 50%. Okay, so it reaches high, I think in November, up to $128, and now it's down to $64. Okay, so um, and so let's see what will happen if we open up a trade. A bear. This is called a bear call credit spread, by the way. If I have not introduced it, so the bear call credit spread. Let's see how this works. So we're gonna open up a bear call credit spread for, let's set their expiration date to February 11th, and then we're gonna go ahead and we're gonna buy a call. So let's do this. Let's go ahead and sell the call first. Okay, I usually like to sell a call, and then we're gonna buy the call after that to kind of close off the position. Okay, so as you can see now, right, we're essentially risking $25 to make $75. Okay, so instead of shorting a stock, you're really covering your position so that you do have a limited amount of risk. So you won't just leave yourself exposed to unlimited risk in case the stock actually goes up. Okay, so now as you can see, if the stock just moves downwards a little bit, or it has just a little bit of room to move up, but basically if it moves down, you're gonna make about $75. If it doesn't, if it moves up, then you're gonna lose some money. But the max loss is only $25 versus the max profit, which is $75. Okay, so this is a great trade, especially if you really think a stock is going to go down. And there's a lot of different indicators that you can take a look at whenever you're evaluating stocks that just are overpriced or that could have a downwards movement. So you can look at finviz.com. If you go to finviz.com, you can typically take a look at the RSI. So RSI is the relative strength index. Okay, so it just basically means if it's overbought, oversold, it's not, completely accurate every time, because sometimes the hype is what's driving the stock up. But in this case, RSI for Rivian has been down a lot just because it's been selling off quite a bit. And so right now it is oversold, so more people are selling than buying. And that's just one of the indicators you can take a look at. Of course, you can take a look at PE, so price to earnings ratio. Let's take a look at Rivian right now, the price to earnings ratio. So it doesn't have it for Rivian, I think, just because it's so new. Let's take a look at just another company just to take a look. Okay, a lot of these EV companies do not have a P ratio, but as I mentioned before, AAON does have P ratio of 67.56. Oops, I think I might have. Yeah, so 49.23, sorry, 49.23, and so that is pretty high for this company. We're going to take a look at one more company just to kind of really seal in this example and really show you how this bear call credit spread works. So we're going to take a look at tech stock. Okay, and keep in mind, this is not just like any tech stock. We're taking a look at a specific company with the stock ticker tech. Okay, so here it is. Okay. Okay, so tech stock is a company called Biotechnine, a corporation. They develop different research and bioprocessing products for the market. They basically just do a lot of R&D in the biosciences department. I found this company through one of the stock screeners, and right now it's sitting at a P ratio of 84.79. Compared to the price to earnings, just the amount of revenue they're making, I just don't think this is a great stock right now to buy. I think it's a great stock to sell. And so we're going to take a look at what this looks like in our options chain. So let's take a look. Let's take a look if we were to short this stock, but do it in a more less risky way. Okay, so where we can cap off our risk. So we're going to go into Robinhood. we're going to do trade options. And again, we're going to go ahead and start by selling an option. So we're going to sell a call. And let's just sell the call at, I don't know, maybe just a couple strike prices beneath the current strike price. And then we're going to buy the call immediately above that. Okay, so right now that's already a pretty good trade. This allows the stock to continue to move downwards. If the stock moves down by more than 5%, 5.61%, we're going to make about $650. We're risking $350. Okay, so we're going to adjust this a little bit. Let's say we go ahead and sell the call at 350, and we buy the call immediately above that. Let's see how that changes up things. Okay, so same thing, except we actually made the trade a little better. So sometimes you can kind of adjust the strike prices just to kind of figure out what the optimal strike price is to either reduce your risk or to maximize your profit. In this case, we just reduce the risk because now, tech stock, this TECH stock only has to move down by about 3.33%. Okay, so let's go one more. Let's just see how this will look like if we set up to where we sell the strike price immediately below the current strike price, so the closest one to 360, and we buy the strike price above that. So now as you can see, we reduce the risk. Okay, so the stock only has to move down by 0.39%, but you're exposing yourself to more loss. Okay, so there's a potential for higher loss, and your max profit does go down. Okay, so it just really depends on how confident you are with the movement of the stock. Sometimes, honestly, it's harder to predict, whether a stock will move down, just because, you really have to take a look at a lot of things, and even if it sort of makes sense, where you see a stock that is just overvalued, it's overbought. Sometimes the market doesn't make sense. And that's one thing that I've learned in 2021 is a lot of times the market really, really won't make sense. Okay, so that's just a way that you can short a stock without really shorting a stock, but you can basically bet that the stock is going to go downwards, and if you are right in your call, you're going to make a lot of money. So remember, you start out by selling a call option, buying a call option with a strike price immediately above that, and that is called the bear call credit spread. Okay, guys, I hope this video is helpful for you. If you like this kind of content, if you want me to make more videos like this, make sure you smash that like button, subscribe below, comment below if you haven't already. And until next time, guys, I'll see you around in the next video.